Chapter 14, Types of Financing. When we think about a mortgage, the first thing that comes to mind is usually a fixed rate mortgage, where the interest rate remains fixed throughout the term. So that means the payment is fixed as well, each and every month. The term is fixed. And a fixed rate mortgage is fully amortized, meaning that with each payment, some goes to the reduction of interest and some of the payment goes to the reduction of the principal. By the time the very last payment is made, zero is left on the mortgage. In other words, the balance outstanding is zero. But there's only so much money to go around at the fixed rate. Thus, through financial innovation, other types of mortgages have become available that allow more and more people to participate and have access to credit. Let's first look at the adjustable rate mortgage. This is a mortgage in which the interest rate rises and falls with changes in prevailing interest rates. While this might sound a little scary, actually there are some safeguards that are built into the adjustable rate mortgage that at least take away some of the uncertainty. For instance, the interest rate on the mortgage is tied to an index, and the most popular index is that of the 1-year Treasury. The interest rate is made up of two parts. That's what's called the margin, and that's the lender's cost of doing business, its risk and its profit. The margin does not change. It's usually about 2 or 3%. The margin is then added to the index. That's equal to the interest rate on the mortgage. So as the index changes, the interest rate on the mortgage will change as well. But how often does that occur? Well, we need to look at the adjustment period on the mortgage. The most common adjustment period is 1 year. The adjustment period is the time between which the interest rate on the mortgage and hence the payment changes. This is the time between adjustments. Thus, for an entire year, you would have this, if you took out an ARM, your payment would remain the same for a year. After the first year, well then there's the possibility with the change in the index, there would be a change in your interest rate on the ARM as well as your payment. ARMs also have an interest rate cap. This is a ceiling of how much the interest rate can change during an adjustment period as well as during the lifetime of the ARM. And these caps must be disclosed. There's also a payment cap. That's a ceiling on how much the payment can change from year to year. ARMs have the potential for negative amortization. This is when the loan balance rises even as payments are continually made. But here too, ARMs have certain safeguards which prevent or protect borrowers from having to owe a tremendous more than what they originally borrowed. And there are disclosures. Remember that with the Truth in Lending Act and Regulation Z that there are disclosures that have to be made. Well, that federal law requires creditors to state the maximum interest rate an ORM can adjust to. In other words, they have to disclose what the worst case scenario could possibly be on an ORM. Now, what makes this appealing is that the interest rate on an ORM in the very beginning is usually a little bit lower than on fixed rate mortgages. Of course, there are positives and negatives for both the lender and the borrower when it comes to the adjustable rate mortgage. When rates go up, the payment will go up. That protects lenders from interest rate risk. But when rates go down, that means that's good for the borrower in that their payment will go down as well. We looked at a graph of what the payments on an adjustable rate mortgage might look like. It might look like this, whereas with a fixed rate mortgage, the line would just be one line straight across our table. There are other types of financing available as well. For instance, the graduated payment mortgage. That's a mortgage where the payments are graduated. In other words, they increase by a certain amount or a certain percentage each year. This helps borrowers qualify for loans by basing the repayment on their salary expectations. So while this is a fully amortized mortgage at a certain interest rate, the payments will start very low and then increase every year by a certain percentage or a certain amount, so that by the time the final payment is made, it is fully amortized, just like a fixed rate mortgage. And again, it is appealing to people who are starting out with their first jobs, and of course that first salary will not be all that high, but as time goes on, as you put in your time and you are either promoted or you switch jobs, your income will increase, and of course your payment will increase too on that mortgage. Another type of financing is what's called equity sharing. This is when the party providing the assets, providing the financing, gets part ownership. So the lender has assets to share in exchange for part ownership. A variation of equity sharing is what's called the shared appreciation mortgage. This is when the lender earns some of the appreciated value of the property, and initially the loan is made at below market rates. Rich uncle financing is also another type of equity sharing, and this is usually when a friend or a family member loans money to someone wishing to buy real estate. A package mortgage is a mortgage that secures both personal and real property. A blanket mortgage is a mortgage secured by two or more properties. In order to sell one of the properties that's under that blanket mortgage, the borrower would have to secure a partial release from the lender A reverse mortgage, which is also known as a home equity conversion mortgage, is aimed at the elderly. They are house rich with lots of equity, but ordinarily cash poor because they're existing. The only income to most of the elderly comes in the form of a pension, and it doesn't necessarily cover all of their monthly expenses. Well, with a reverse mortgage, the elderly can apply for, and then they can receive either in a lump sum or monthly payments, which will help to supplement their daily operating expenses. The mortgage is repaid when the borrower dies or they sell the property. A construction loan is a type of interim loan. This is a short-term loan used for a new construction or for remodeling. It is very high risk because the improvement doesn't exist yet. Thus, the funds are doled out in payments rather than in a lump sum to the borrower. After the improvement is constructed, the construction loan is replaced by a permanent commitment. A blended rate loan is an existing loan at a low rate refinanced by a new loan plus principal at a rate below the old mortgage, a rate between the old rate and the prevailing market rate. An equity mortgage is a second mortgage used to tap into a homeowner's equity that results from rising home prices or a decrease in the first mortgage loan balance. Let's turn our attention to affordable housing loans. An affordable housing loan is an umbrella term that covers many slightly different loans that target first-time home buyers and low to moderate income borrowers. Here, the underwriting standards are a little different than what we learned in some of our earlier chapters, when for most FHA, VA, conventional loans, we looked at the Uniform Residential Loan Application and all the information that was required when applying for a loan. Well, some of that information that's required had to do with your net worth. How much money do you owe versus the things that you own? And some of that information required had to do with your bank accounts. Well, there are members of our society that don't have bank accounts, but they do have good credit in that they do pay their bills and they are responsible. So with affordable housing loans, the standards have been modified to recognize that not everybody has a bank account, but they still have good credit. So they may prove such by bringing in their history of, let's say, rent payments to a landlord. They may be paying them in cash or using a money order. Likewise, they may be paying their bills such as utilities and their phone bills using cash or a money order. So if these people can prove that, they have good credit. They just might not have the traditional form of credit responsibility. A requirement to take part in one of these affordable housing loan programs is that a potential buyer does need to have a certain form of home buyer education. That might be attending a class face to face one evening or taking a course online that's available through these particular programs. What distinguishes these programs is that they all require a low down payment, or there are programs that provide grants for the down payment. So that means they're not required to be paid back. If that's something you might be interested in, I would refer you to the Capital Area Financing Authority website. Google Capital Area Financing Authority and you'll get loads of information about affordable housing programs. With a wraparound mortgage, and here is a graphic related to the wraparound mortgage. Remember, that is a mortgage that encompasses any existing mortgages and is subordinate to them. And some other financing tools that have emerged over the years include the option. This is used when there is a need to finance the full price, but it's postponed. A rental, in a way, is a way to finance but not buy the property. A land lease or a ground lease is when a long-term tenant builds improvements. Those improvements are going to remain after the lease is over, But since the lease is so very long, we're talking about 40, 50, 75, almost 100 years in length, that certainly the tenant has recovered the capital necessary to build that improvement. Some other forms of creative financing includes things such as the sale and the leaseback. And it is certainly possible to invest in mortgages through a host of different ways, including some of the things we talked about in our last chapter, where one would purchase securities backed by a pool of mortgages. Remember, that all has to do with the secondary mortgage market. And here are key terms for Chapter 14.